Much, Mr. Kinlock. May I request you to come on stage for our open forum? May I also request Mr. Anthony Hobro and Mr. Mins on stage? This is also a working coffee break, so please feel free to have your snacks as we listen to the questions and answers regarding these subject matters. You may use the microphones on the floor, and please identify your name and your company when asking questions. The table is now open for questions. Who will shoot the first question? Can we have additional microphones for our panelists? Questions? Mitch.
David, this question is for you. All right. Inasmuch as that it is foreseen that the EQ coverages will be mandatory, and inasmuch as the local insurance industry is already covering a portion of this target market, there is a concern that this portion will be lost to them, as the model currently being pursued will relegate the local insurers into mere channels of distribution. But you also mentioned that this is not true. Can you please elucidate?
Yeah. Bear in mind two things. First of all, we are only looking at one particular section of the market. We're not talking about earthquake insurance across the board. We're not talking about large industrial risks. We're not talking about expensive homes and property. Bear also in mind that according to the FILNA statistics, there are probably only about 40,000 policies in force at the moment with either earthquake cover or an earthquake endorsement on it. If the local market was flooded with even another 40,000 or 80,000 policies over a 2 or 3 year period, the capitalization requirements, the solvency margin requirements would change completely, and a lot of companies would not be able to write the business. Whereas, if you take this into a specialist insurer, then you have freed up capital, you're able to continue with your current solvency margins, and you don't have the same risk exposure across the marketplace. There's one other thing we should touch on, and that's loss settlement. There is nothing more devastating, ladies and gentlemen, than to have to adjust catastrophe losses. To go into towns and villages which have been devastated by earthquake, typhoon, hurricane, windstorm, whatever it might be, and just see this total devastation, the total despair of the living, the total concern of the injured, and everything else. We saw it in microcosm in Bohol 10 days ago. I saw some photographs on the Philippine news. If you are going to put even 20 insurers into a catastrophe situation, you will have 20 different claims settlement solutions. And some insurers will say, we'll pay you half now. Some will say, and I've seen this, I've heard it in many countries, oh, can you show me the original policy, please? And you point to a pile of steaming rubble and say, yeah, it's in there, go get it yourself. If you have one highly capitalized, highly mobile professional insurer with one standardized claims settlement, loss settlement procedure that is public and transparent and everybody knows about, that is much more beneficial. This is not about feeding a market. This is about protecting a nation. And it's very important that everybody gets that. If all of the members of PIRA simply go to their own domestic self-interest, then frankly, my friends, you're doing a disservice to the country. You must look at this on a much bigger basis. It's not, but I'm losing gross premium, or you're taking all this away from me. First of all, you haven't got it anyway. 99% of this is going to be new business. Secondly, much of the market can't cope with the undercapitalization. And thirdly, the duty of care and responsibility that you owe to the people post-loss is the primary consideration, or should be at all times.
Next question, please, from the floor. Yes?
Are you going to require that the participants of the pool have an international credit rating?
I'm sorry, there isn't going to be a pool. It is going to be a separate, standalone, direct insurer. We looked the working groups looked very carefully at whether or not a pool could work, and it simply cannot work in the Philippines. I'm happy to talk to you about that later.
Next question, please. Yes? Yes. Well.
Just a question for Tony, purely to tie back the opening speech really about cybercrime, and basically because it's very important that online insurers promote a good reputational risk to people so that they will get even more people coming online. So as an online insurer, there's a cloud involved, there's a lot of different people involved. That could bring back some kind of breach to you, and then you need to understand that to subrogate as well against all these retrocessional cloud providers. So how does an online insurer show they have the security so that the reputational risk is always intact?
Thank you, David. I can always rely on you. That light is so bright. The basic question, how do we show that? Actually, in our own case, we're not on the cloud yet. Sorry. When we are on the cloud, no doubt you'll be knocking on my door to provide the solution, as I know you have one. At the moment, we use normal risk prevention to the highest possible standards we can. And it's actually quite, it's kind of relevant, but I don't know, those of you know that Singapore was kind of half brought to a halt recently because Singtel houses an awful lot of the hub for a lot of the cables that run around Singapore. And there was huge disruption for a week or 10 days to quite a lot of people and businesses. It's actually worse than's been in the press, because I know actually that the data center that the vast majority of businesses have their backup in is also in one single Singtel tower. And it just scares me what happens. Now, we're triangulated across 3 countries, which is incredibly unusual, if not the only insurer I know in Singapore who has that kind of backup. So, I mean, it's many, many levels of walls and encryption and backup. But our cloud, when we go to the cloud, I'll be looking at you, I'm sure.
Okay, so this will be our last question, sir. Yes.
On the earthquake pool again, insurance. Actually, I currently cover 400,000 families nationwide with 4 billion risk on earthquake. And I'm surprised you said that your studies, we have only 40,000. But this is the microinsurance space. How then will this company provide the traction for the poor, because this is not covered by any government scheme? And at this moment, I am processing more than 10,000 claims in Bohol and Cebu alone. So how would this be able to provide traction for the poor?
The new company has been specifically designed and will be specifically for middle-class residential and SMEs. As I said to you earlier on, the less fortunate are able, thank goodness, to look to people like you for microinsurance. Those above the brackets that we're looking at are able to purchase commercial insurance or to self-insure without significant economic loss. The government came to ADB several years ago looking for this middle-class solution, and that is the solution that we're going to provide. No organization can be all things to all men, much though we would like to be. And the next stage is, well, why don't we do typhoon as well? Why did we start with an earthquake? Why don't we do landslip? Why don't we do tsunami? There has to be a starting point, and the devastating financial, socioeconomic, and human cost of earthquake to middle-class residents and SMEs and to the country as a whole is deemed at this present time to be the most important one that is not properly covered by insurance. Statistic, depending on who you listen to, but the minimum number I've heard is 15%, but something between 15 and 40% of all OFW remittances back into the Philippines go towards the provision of residential housing. That is a huge socio-economic risk in the marketplace. And if you go back to Senator Angara's comment, just because you've fought yourself up doesn't mean to say you can't go back down. So it is a sector that requires very careful thought and very careful coverage, which is quite often neglected, not just here, but internationally.
Thank you very much to our distinguished speakers. So at this point, may we invite on stage one of our members of the Board of Trustees, Ms. Claire Chua, together with Deputy Chairman Mitch Reliosa, to hand the plaques to our distinguished speakers. Let me just read a citation. The Philippine Insurers and Reinsurers Association awards this plaque of recognition to Mr. Tony Hobro, Dennis Means, and David Kinlock for making the 2013 PIRA Stakeholders Convention a huge success. Given this 25th day of October in New World Hotel, Makati City, signed Emmanuel Arque and Michael F. Reliosa from PIRA. So once again, thank you very much to our distinguished speakers. And moving on to our next topic. This afternoon, we have another discussion about investments. After learning about the Philippine investment environment, we'll now be discussing about professional fund management and products, which insurance funds could be lodged to generate higher yields. Our speaker for this session is from the Bank of the Philippine Islands. He's currently the head of investment for the Odyssey investment team of the BPI Asset Management and Trust Group. A graduate of the Ateneo de Manila University, his career includes a stint in finance for a New York-based retail company, and later as a Treasury Department head for fixed income and structures and derivatives at Metro Bank. He was previously the portfolio manager of the ING and now Odyssey Philippines Fixed Income Funds. He is also recognized as one of the most astute investors for local currency and for Asian G3 bonds by the Asset magazine. With over 20 years of experience in the field of investment management, our speaker today makes strategic investment decisions over a portfolio that is worth more than 100 billion pesos in assets, allocating client funds in both fixed income and equities that are both here in the Philippines and globally. Ladies and gentlemen, a round of applause for Mr. Smith Chua.
Good afternoon, everyone. In the past 5 years, since 2007, investors in our local markets were richly rewarded. Perhaps because of the great financial crisis that began in 2008, followed by the Eurozone crisis thereafter. All Philippine-related asset classes were achieving new record highs. Now, if you had stayed invested throughout the 5-year period, the cumulative return in our stock market was 60%. For the Philippine government securities, it was 51%. And for the US dollar Philippine bonds, its return was the highest among the three at 71%. It's no surprise, therefore, that the Philippines was ranked as one of the best performing markets in the world. For those in the market in the last 10 years, you probably noticed a significant change in investor perception on the Philippines, from one that is most negative to that of positive. Earnings, we earned the upgrade to investment grade from all three rating agencies, and this was the reward for the successful management of our economic policies as well as political governance. A high premium was demanded by investors in the past before they would put their money to work in our economy. The downward shift in our interest rates best shows how that perception has changed over time. For instance, just to give us an example, in terms of interest rates, in January 2000, at the height of political risk, a slowing economy, and a fast dwindling foreign exchange reserve, our inflation rate was recorded at 6%. On the other hand, our 10-year government securities was yielding at around 15%. So that's 6% for inflation and 15% for GS yields. If we have those kind of GS yields today, I think everyone in this room would be extremely happy and be celebrating. That difference now between the inflation rate and the GS yield is what we call the risk premium. With any insurance product, I think you have a risk premium. For us in investment, we have this type of risk premium. So, as history shows, since the EVAT was introduced in 2005, the risk premium at first gradually shrank. But in the last few years, the pace of decline in the risk premium accelerated as the country's monetary, fiscal, and economic health improved dramatically. In fact, our budget and debt ratios look exceedingly better than many AAA countries, and perhaps because it was that obvious, the credit rating agencies granted us the upgrade. I think it is safe to say that most of us are pleased with the developments in our economy and financial markets. Of course, not all is perfect. But I think you will agree that those factors that seriously threaten our economy before has significantly diminished today. As far as financial markets go, this year marks a very important milestone. As everyone knows, the U.S. Federal Reserve sent a warning shot that shook the market. The U.S. Central Bank unexpectedly announced that the days of very easy monetary policy are numbered. This surprise announcement saw foreign investors pulling money out of the emerging market and back to the U.S. Lately, however, the U.S. Federal Reserve pulled another surprise by delaying the timing of that withdrawal of liquidity. It may perhaps take a few months or even longer, depending on the strength of their economy, before they would withdraw that liquidity. But let's not be lured into complacency. Let us learn from the recent experience. The recent events clearly showed us who the winners and the losers are. The emerging markets lost, and the developed markets won, especially their equity markets and their currencies. While we will eventually see higher rates in the future from these developed countries, which is negative for us, we believe there is a silver lining behind it. The good news is that the underlying economies in the US, Europe, and Japan are starting to grow stronger. And this trend is likely to continue in the next few years after dealing with the aftermath of the great financial crisis and the Eurozone crisis. For Japan, its policymakers are making significant headway in pulling the country out of 2 decades of stagnation. I think what we have learned here is that volatility will always be with us. For investors, perhaps, there is an opportunity. We believe it pays to diversify, and more importantly, it pays to be prepared. For today, therefore, along your theme of innovate or stagnate, BPI would like to present you an avenue by which you could invest in the developed markets. We present to you the BPI Global Equity Fund. The BPI Global Equity Fund is currently invested in the equity markets of US, around 56%, Europe, 20%, Japan, 9%, UK, 8%, and the other 5% in emerging markets. The fund is unique in that it does not invest directly in the stocks in those countries. Rather, it invests in offshore mutual funds that are being managed by fund managers such as JP Morgan, ING, and others, who have shown their ability to perform. We chose to invest in their funds in order to utilize their resources and research that are already in place in those countries. BPI would not have the resources to duplicate these same efforts in more than 20 countries covering thousands of stocks under this coverage. The idea of diversification is actually not new in the Philippines or in BPI. This fund, which has been started many years ago, is a unit investment trust fund that is registered with the BSP and has been available to local investors. Going back now to these developed countries, you may be asking, what would be the factors that are going to drive their economies? Let's start with the US. First, their housing sector is making a comeback. Houses were being sold like hotcakes today, and prices are up 12% year on year as of the latest month, and even higher in some select states. Housing is a big job generator and is the biggest factor in the multiplier effect of the economy. The second driver is the energy industry. This sector is booming as new technology such as fracking enables the extraction of oil and natural gas in existing resources at very economical cost. At the pace that oil is being produced in the US, HSBC estimates that the US will exceed Saudi Arabia to become the #1 oil producer in the world by the year 2020. The third driver is manufacturing. It is well known that US manufacturing relocated to China. However, wages in China, among other factors, rendered it less competitive. Hence, companies like Apple is leading the charge to move its manufacturing facility back to the US. We expect more companies to follow. Lastly, the healthcare sector in the US is robust and well. Obamacare will actually mean more insurance coverage for the insurance industry. Despite the government shutdown and negotiations for raising the debt ceiling stalling repeatedly, the US equity markets had continued to gain new record highs. Going to Europe, the Eurozone had recently exited from 6 quarters of recession. Ireland, Portugal are soon coming back to the international market as successful reforms have attracted investor confidence. Spain and Italy are making significant political progress as well. The economy in Europe is in the stability stage, and we expect more significant policy changes ahead of the Eurozone, such as their fiscal union. Japan has also made major strides in government policies, which were initiated in quick succession in a short period of time since the new prime minister took power in December. The combination of very easy monetary policy and fiscal stimulus has led to the weakening of the yen and to the increased profitability of companies. Tax and labor reforms are expected to be tackled next. Now, the next question that probably comes into mind is, if the developed countries are doing well, what is the impact on the emerging market countries then? Will the emerging market benefit? Our answer is a qualified yes. Those emerging market countries that sells or exports goods or services to the developed countries should benefit from the demands of those developed countries. In this case, Asia is the region that we think will do well. But apart from the reason that Asia is a tremendous manufacturing base, it has also other promising possibilities. For instance, 2/3 of the world's population live in this region, what with India and China alone accounting for 2 billion of that population already. Hence, Asia provides a rich source of consumers for companies that provide goods and services. In fact, wealth in the region has grown exponentially. That Royal Bank of Scotland predicts that by 2014, Asia will have the most number of millionaires in the world, exceeding the US. As ASEAN integration gradually materializes from 2015 onwards, we could see increase in intra-regional trading, with mineral and agricultural resources being one of the beneficiaries. One by one, each country is gradually striving to reach the first world status. To complement our BPI Global Equity Fund, we present to you our second fund, the Odyssey Asia Pacific High Dividend Equity Fund. The fund is invested in Asia and in the Pacific countries, but excluding Japan. Currently, a quarter of the fund is placed in Australia, followed by Hong Kong, China, Singapore, with equal weighting of 15% each. The fund's value is linked to these countries' movement in their equity markets and in their respective foreign exchange. JP Morgan Asset Management, the sub-advisor of this fund, is focused on picking stocks that meet the minimum 2% dividend rate and has good fundamentals to sustain this payout. One benefit of this fund is that it is defensive. When markets turn bad, this strategy tends to outperform due to the natural flow of dividends earned. Like the BPI Global Equity Fund, the Odyssey Asia Pacific High Dividend Equity Fund is registered with the BSP and has been available to local investors since 2008. Well, ladies and gentlemen, it's a short presentation, and I've come to the end of my presentation. We hope that somehow we were able to give you some ideas in your innovate or stagnate theme. In behalf of the BPI Asset Management and Trust Group, I thank you for inviting us and spending your valuable time with us this afternoon. Thank you, and we wish more success to all the members of Philippine Insurers and Reinsurers Association. Thank you.
Thank you, Mr. Chua, for sharing us your insights. With the passage of the new insurance omnibus law, there will be opportunities for new investment strategies. The challenge is how and when are we going to invest, and the learnings that we have to undertake to make sure that there is prudence in our investments. Please hold on to your questions because we'll have another open forum after the next presentation. We'll proceed to the last, but definitely not the least topic, which will always be relevant to all of us, the reinsurance market. This afternoon, our speaker will give particular focus on what is happening globally, as well as in Asia, some in the Philippine market, and new reinsurance strategies vis-a-vis capitalization issues. Our speaker for this topic is the Senior Vice President of Guy Carpenter Singapore, where she is part of the team that develops business in Southeast Asia and India, as well as assists in managing relations with Guy Carpenter's carrier partners. She has had 27 years in the reinsurance industry, starting her career as a reinsurance broker in the Philippines. Prior to joining Guy Carpenter, she was a client manager at Swiss Re in Singapore. Ladies and gentlemen, let's all welcome Ms. Sandra Kapay.
Good afternoon. I'm so happy everybody's gone. No more questions. Reinsurance is going to be smooth moving forward. I'm really happy to see old friends. I hope to give you good news, but I think more than good news, it's to prepare you for what's happening in the global reinsurance market. I'm also pleased that Mr. Chua presented before I did, because I certainly am not a financial expert, although in the current presentation, we will need to touch on capitalization and trends, so interest rate trends in the market that affect the capital base of the multinational reinsurers. So today, you have tasked me to present on the state of the reinsurance market, the challenges and opportunities that this will present to our industry. I will also share a summary of the renewals that took place in the course of 2013, and will touch upon the Philippines, although maybe Bobby Crisol of Philna Re would have a better traction of the complete scenario. Oops. So there are three items, three subjects that we will touch, and that's the capital sector and its influence in the renewal pricing, the challenges and influence of the buying behavior of reinsurance, and maybe the scenarios that we will have to consider moving forward as we get close to the 2014 renewals. Still not loud enough, my God. So, in spite of the cat losses reaching approximately 20 million US dollars during the first half of 2013 alone, and this is well above the 10-year average, there has been an influx of capital from third-party investors. An estimated 10 billion US dollars of capital has entered the market over the last 18 months in form of non-traditional reinsurance. This is the global reinsurers estimate based on the actual deployed capital in 2012 versus 2011 alone. And the movement is approximately 13%. And the graphs here will show a split. Probably it's not showing very well, but the split between the European markets, which is the biggest cut here, Lloyd's, and the last bit of it would be the other Asian reinsurers. Tracking the composite capital possession, and this is not the global. This is a group of companies that we at Guy Carpenter monitor closely, so we have a comparative market movement at all times. Since 1998, regulatory measure caused an increase in capital for NatCat exposures in the middle of 2007. Oops, sorry about that. So you will see that there is a spike up just about 2007. Can you see it? Since then, though, capital has been in excess through the second quarter of 2013 from 2009, following the financial crisis just about 2008. The dotted line represents the long-term capital to reinsurance trend, and that's currently above 10%. 9/11 in the graph would be just about where it dips in 2001. After the financial crisis, the shareholders' funds had built up between 2011 and 2012, aided by strong net income and settling approximately at 119 billion US dollars by mid-2013. And approximately 34 billion US dollars is dedicated to Asia alone. That is a steady growth of approximately 20 billion US dollars since early 2010. Institutional capital pursuit of cat risks has been raised by in a low interest rate environment, which Mr. Chua also touched upon. Short-term yield chasing, however, is not the primary driver of the inflows in reinsurance. Stable capital has been spent years evaluating cat risks and the asset classes and looking for steady returns in the aftermath of covered events. Stable capital that has been waiting to see organized trading activity during the live cat events such as Hurricane Irene in 2011 and most recently Superstorm Sandy in 2012. On all fronts, the catastrophe market has demonstrated it is ready to transition with a better understanding of the business. This graph shows that the highest NatCat losses events were in 2005, that's Katrina, and 2011, which is a combination of Tohoku, New Zealand earthquakes, as well as the Thai floods. I know this statement probably contradicts Mon's numbers a little bit earlier, which I made a record of, because he did say that for him 9/11 was the most expensive loss. But these are all index claims, and I don't know if, Michael, would you agree to this? He agrees. He's a friend, so he has to agree with me. The 1911 claim cost the industry approximately 40 billion US dollars, but Katrina and in 2005 and events in 2011, Asia Pacific posed the highest insured losses. So as you can see, it peaks through almost over 100 billion. And today, as most of us know, Thailand losses has not really fully settled, as well as the New Zealand earthquake. We have yet to determine how 2013 will end. We have witnessed hurricanes in the US, flood activities in Asia Pacific, and of course the ensuing bushfires in Australia. Reinsurers, however, posted combined ratios below 100, which is considered good. And this is a record, a best recorded year for reinsurers, and you can see the marked improvement year on year from the previous year. Strong capital building from 2009 cushioned the impact on the 2011 results. So the names that are listed here are very familiar to the people in this market. However, in Asia, the scenario is different. If you look at the Asian reinsurers, the 2012 was actually a disaster. Combined ratios reached a high of 200% in 2011. And the companies based in Asia are listed there as well. Reinsurers had to recapitalize to meet the unexpected losses from the Tohoku earthquake and the Thai floods, to manage the threatened downgrade from the rating agencies as capital adequacy was closely scrutinized by both the agencies and the reinsurance buyers. The events of 2011 did force a reevaluation of underwriting guidelines, certainly in respect of natural catastrophe perils, as well as the cross-border expansion prompted by cost and restrictions in the retro programs. By 2012, reinsurers were actually not out of the woods. Loss reserves of 2011 event continued to be adjusted then. This graph aims to show you the gaps between the insured losses and the reinsured losses, and the numbers that have been circled are the reinsured loss ratios. So you see a stark improvement in the gaps from 2005 all the way down to 2013, where the gap between insurance and reinsurance losses actually narrow considerably. In 2013, Asia Pacific represented 20% of the global reinsurance. And that is way above 10% from 2010. However, this is just another graph that shows you what the loss scenarios are in Asia. And you can well see that Asia falls below par in results compared to the global ratios. I will attempt to give you an overview of what occurred during the 2013 renewals. The listing is actually in your pack. So we will go through an overview and let you get off the afternoon quickly so you can enjoy your drinks. So we start off the renewals in June and July. Impact is most dramatic in the US, where the first time ILS, or non-traditional products, were being offered at the most competitive terms that threatened the traditional market. Alternative reinsurance activity throughout the year for the first time were at levels that had prompted downward pressure on the overall traditional market pricing. So currently, non-traditional takes about 15% of the total reinsurance spot, but it is expected to grow from $34 billion to 57 by 2016, mainly in bonds and collateralized segments. This is all in your pack, so we're not going to read through that. In Asia Pacific, most of the renewals are spread out in the months of January to July, although more and more, for us brokers, it seems to be happening through the whole year round, so the schedules are probably going to change in the near future. No shortage in capacity was felt in comparison to 2011, just after the aftermaths of Tohoku and the Thai floods. And despite increases in the cat limits that were demanded by the insurance companies, of course. And this, I think, is a result of the loss activity as well as a reduction in the availability of nat-cat perils in the pro rata programs. In Australia and Japan, alternative capital may be sought and could drive the rates downward moving forward. The trickling effect was, of course, felt in the rest of Asia. Global capacity is more than adequate to meet the demands in Korea and the rest of the other countries. New capital, therefore, was limited to the retro space. Moving forward, stronger regulations, solvency regimes, and rating agencies will even prompt an increase in demand for nat-cat protection. In the Philippines, new capital found its way, providing pro rata capacity to the market that was otherwise headed to a non-proportional solution. Reinsurers picked up losses from flooding in 2012, continuing through 2013, and the recent earthquake in Bohol and Cebu, where insurance companies are expected to pick up losses as well. Attachment levels that are considered low in this market were adjusted upward, and rate on lines remained either flat or risk adjusted based on the individual treaty results and exposures. Reinsurers will continue to assess the cat exposure in this country and look for better ways to manage loss-contributing portfolios despite the need to grow. So I think what I am saying is, although there is a softening trend, overall, the reinsurers will really take a look at the loss ratios of the programs moving forward. But capacity will be there, and it is available maybe at the price. Seemingly, the soft market might continue in the near term. And this is again trending the pricing through from 1990 all the way down to the early part of 2013, despite spots of nat-cat events in 2013, but without further significant cat losses in the remaining of the year. But 2013 has not as yet ended. We did mention that interest rate is going to influence a lot of the pricing. How much of this will it actually impact pricing as such? Before the crisis, the recent financial crisis, the norm or the average growth was about 4%. And this does not go as far back as the Great Depression and World War II. You will probably laugh at that statement, but the economists would always refer to those two depressions as well. And the new normal is likely between 2 to 3%. And these slides are provided, but some of you who have financial acumen will likely understand this better than I do. But this is really just showing to you the interest trends and the effects on the capital of the reinsurance markets. Reinsurance companies will have to consider capital optimization as well as they do protection, seeking opportunities to securitize the most capital-intensive parts of the business, and that includes nat-cat, whilst providing cost-efficient capacity to their clients. More and more, the reinsurance companies are taking on board capital market experts dedicated to attract and manage investment. In the next 3 slides, we will look at 3 scenarios that could likely happen with all the factors that we have earlier discussed. The first scenario is where we have a case of a stable interest rate, moderate reserving trends, and low nat cat traction. In that particular scenario, the pricing trend is expected to decline if the interest rate environment remains low and stable. Reserve releases contributed to the reinsurers' positive results over the last few years, but this is not expected to continue. Therefore, in the three scenarios of this presentation, we factor only moderate to adverse reserving as the contribution, as I said, is not expected to continue. The second scenario is where the interests, there are higher interest rates, but adverse reserving trends, and again, an uneventful year, which will likely drive prices down. However, there is a possibility that the investors have another platform to make better returns, coupled with not cat losses that could increase pricing significantly. So with those current market environments, capital in abundance, negligible growth in global reinsurance spend, and a pricing outlook that threatens to remain soft, reinsurance will be challenged on how to generate growth. What are the options? Could they hold funds for future losses to safeguard against having to raise these funds after a big event? They could return the funds to shareholders in periods of low returns. They could also grow organically or probably go into mergers and acquisition to achieve scale. The changing dynamics of specialty and global reinsurance market will both challenge and offer opportunities. New exposures have been identified. Cyber risk has been mentioned a few times through this presentation. Renewable energy, food and water security, urbanization, which is proving to be the biggest challenge for us, growing prosperity and longevity, will challenge reinsurers to decide on how they should deploy their capital to generate returns for investors and shareholders. And as an industry, we continue to be challenged to bridge the gap between economic and insured cat losses, a gap that continued to widen with a huge amount of uninsured losses, estimated to be US dollars 1.7 trillion between 2007 and 2012. So those, lot of things to think about, and reinsurers will influence the way we do business, depending on how they deploy their capacities and how much we need to pay for that. That is really the end of my presentation. I did not wish for you to slip through the things, but rather I would like you to think about what are the factors that could also affect your operation moving forward, as the challenge is actually quite universal among insurance practitioners. Thank you.
Thank you very much, Ms. Kapay. May I request you to occupy our sofa, please? And may I also request Mr. Smith Chua to join Ms. Kapay on stage as we now open the floor for the second open forum. Questions from the floor? Casey?
Afternoon. I'm Casey from Aeon Benfield. I'm a friendly competitor, so I'll be asking Sandra a very friendly question. Sandra, you mentioned that there's a trend of additional proportional capacity coming into the market. Would you recommend your clients to leverage on this additional proportional capacity coming into the market?
Hello. I should not tell you, Casey. That's your competition. But I'm sure he's saying exactly the same thing as I'm doing. This market has resisted non-proportional protection for NatCat, right? And certainly, it's a cheaper way to get protection. I think and there is absolutely nothing wrong with the proportional program, but the way the reinsurers have viewed it over the past 20 years, I better not go beyond that, otherwise it will show my age. The problem is on a proportional program, especially on surplus, it is not an equitable sharing of the fortunes and the misfortunes. And where markets have moved, not only in the Philippines but across Asia, where it has moved into a free rating regime, there could be a possibility that reinsurers do not find the rates adequate. So, would you consider it? I'm sure that everybody is considering it. There are other factors in deciding who your reinsurance partner should be, and that probably comes into a lot of equation in the Philippine market, where the relationship between reinsurers and the clients here are very strong and have been long-term. Did that answer your question?
Yes, thanks, Sandra. Thank you.
I know there are a lot of questions still to be asked, but in the interest of time, I was advised that it will now be the last question. Or there is no more question? If there is none, may I request our Deputy Chairman, Mitch Reliosa, our PIRA Board of Trustee, Claire Chua, to award the plaque of appreciation to our distinguished speakers. And while they're awarding the plaque of appreciation, I take this opportunity to announce that the awards dinner will start promptly at 6:30 on account of the age and condition of some of our awardees. And you are also requested to stay for the fellowship that follows immediately after the awarding. So thank you everyone for coming. This marks the end of our 2013 PIRA Stakeholders Convention. More excitement and fun are expected tonight in the 2013 PIRA Awards. As what was mentioned, we start with a dinner, and we will be having a film showing at breakout room number 1 right after the convention, so you can relax as you wait. And by the way, please don't forget to come in your futuristic attire, as there will be special prizes awaiting the best dressed futuristic attire for the male and female category. So once again, this is Becky De La Cruz, and thank you all for coming, and see you in tonight's PIRA Awards. Good afternoon.